don't know about you, but it feels very much like the economy and the banking industry is at an inflection point right now. Fed's about to cut rates. We got an election coming up in November. Just feels like we're on the cusp of transitioning to a brand new economic cycle. The problem is, I don't think anybody knows new cycle is going to look like. Some of you could easily get up here and make a strong case for, hey, Adam, things are going to be great. The Fed's going to engineer this so-called soft landing. Inflation's going to be under control. Unemployment's going to be under control. And not only that, we're going to have lower rates. That's great for banks. It's great for borrowers. We're going to have 3 to 4% GDP growth fueled by AI and all these other technologies. Goldilocks. You can make that case. You could also get up here and make the case that, hey, actually, maybe the outcomes won't be so pretty. The inversion of the yield curve has so far been an undefeated predictor of a recession. It's been over 2 years now. People are ready to give it its first L. What if they're wrong? What if we have a recession? Very possible. What if the Fed is too early to the rate-cutting party? Or they cut too aggressively, and all of a sudden, inflation's a problem again. In fact, there's more precedent for that outcome than there is the soft landing. Nobody really knows what this next cycle is going to look like, and in many ways, it's a fool's errand to try to precisely figure it out. But what I do know, or at least I feel damn confident in, we're gonna have a new cycle. Everything's lined up for a new chapter. And I also know from experience, new economic cycles create new winners and losers in the banking industry. Now, it's also strategic planning season, and you have a difficult task with so much uncertainty in front of you, because many of you have to chart the direction of your bank for the next 3 to 5 years. The past 2 to 3 years has been focused on deposits. Deposits, 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 rightfully so. And while that's been happening and you've been focused on that, what's also been happening, maybe not to all of you and probably fewer of you in this room than in the industry as a whole, given how many strong banks are here. But for most banks, NIMs have been compressed, profits are flat or down, and loan growth has slowed or stalled entirely. And loans are still the bread and butter moneymaker for banks. And as part of your strategic plan, your challenge is to develop a strategy and a philosophy for loan growth for the next 3 to 5 years. And that may not be so easy. Loan growth may prove to be difficult. Some of you, and again, we have some strong banks in this room, so I say this humbly, but some of you are so strong, you've already dominated your market. You've already maxed out your market share in your core markets. And if you do nothing else, the only way you're going to be able to grow is if your market grows. And that's not so much in your control. And a lot of you are trying to get your bank to the next level. Maybe you're 300 million in assets, you're trying to get to 500 million. Or you're 700 million trying to cross $1 billion. And so on and so forth. And to achieve that objective, you need to find the next growth curve for your bank. And what it might ultimately lead to is you may have to step outside of your comfort zone when it comes to lending. It could mean getting involved in new types of lending that you don't have as much experience or exposure to, entering or expanding in newer markets that you don't know as well, and you're not as known as well either, lending into new industries, lending to larger customer segments, or even, I'm going to say the C word, developing a concentration, which we'll get into later on in this discussion. But those are some of the uncomfortable decisions some of you might need to make. And when you get outside your comfort zone like that, just know this, it's very normal. That's a natural part of a bank's evolution. So it shouldn't be thought of as a negative. However, also when the most mistakes are made by banks. And that brings me to today's discussion. I want to share with you today 3 principles that I strongly recommend you consider as part of your strategy for growing loans over the next 3 years. And look, these 3 principles I'm going to talk about today, they're not the be-all and end-all. They're not the only 3 things you should be doing, not even close. Also, they're not necessarily meant to take literally. I'm not saying got to be black and white. There are shades of gray to the principles I'm going to share with you today. But the reason I picked these 3 principles is because, in my experience, they are under-discussed and grossly overlooked by the banking industry. And the banks adhere to these 3 principles at the beginning of a cycle are always better off. And if you consider these 3 principles and fit them in a way that makes sense for your bank, I know for a fact, because I've worked with a lot of banks, and I've seen banks make mistakes more often than anything else, but I've also seen banks adapt these principles and be very successful. But if you adapt these principles, you'll make fewer mistakes. But I think more interestingly, you'll have conviction to zag when everybody else is zigging, and in the face of pretty high degree of economic uncertainty, you'll have a compass. And it'll be a compass that, it may not tell you what house on the street and what street you need to be on, but it will tell you what direction to go in in and potentially what neighborhood you need to be in. And it will prevent you from over or underreacting to economic conditions. And you'll be able to pump the brakes or put your foot on the gas faster than your peers. That I know. So let's get into these 3 principles. Principle number 1 is actually an old adage, but it's an old adage bankers always forget and then remember when it's too late. And that old adage is the worst loans are always made in the best of times. And what I'm really trying to say here is this. Vintage, or really what I'm trying to say is the economic conditions and the interest rate conditions that exist the day you make a loan in many ways comprises its risk profile more than anything else. I will tell you from my experience, the worst loans I've ever seen in my entire career all had one thing in common. They were all made in 2005, 6, and 7. And that's when times were really good. That's when just about every borrower qualified for a loan. That's when the worst loans were made. I'm not, forget the egregious ones. We know about the egregious stories. But even regular loans, there was a lot of bad loans made in that period. Now, I'm not saying every loan made in that period was bad, but what I am saying is just about every horrible loan I've ever seen was made in that period. 2 different things. Now, if any of you are wondering, what's the second worst group of loans I've ever seen in my career? I'll tell you. Actually, loans banks have made pretty recently. It's loans that banks made, not all loans, some loans, in 2021 and in the first half of 2022. I've seen some pretty crappy loans made during that period. And the banks that made too many of them right now are paying the piper. They're paying the piper because they're under massive regulatory pressure and they're seeing their asset quality metrics deteriorate. Even if we avoid a recession or even let alone a severe recession, they're paying the piper right now. Keep in mind though, the opposite of this old adage is also true. The best loans are made in the worst of times. You want to know the best loans I've ever seen in my career? What they had in common? They were all made in 2010, 11, and 12. And it's pretty ironic because that was a pretty rough period for our economy. Unemployment for most of that period had a 9 handle on it. GDP, we couldn't get off the ground. It is really ironic. Real estate prices had fallen by 30 to 40% by that time period. But think of it this way. Mostly every borrower looks good in good times, is bankable in good times. Not every borrower is bankable in bad times, right? It's the most resilient borrowers have proven to be bankable when times aren't so good. Also, let's just say you made a real estate loan in 2010. Well, ironically, the collateral is very safe because when you got an appraisal on that property and say you made it, I don't know, pick a loan of value, 70% loan of value, that V was already depressed by 30 or 40%. So ironically, there was more upside potential in that property appreciating than there was more downside risk. It's ironic. At the end of the day, you can't control the economy. You can't control the interest rate environment. What you can control, though, is when you grow and your underwriting. Now, look, trying to time the market is not what I'm trying to say. But you know what you don't want to do? Be one of those banks that never met a loan they didn't like in 2021 and now paying the piper. So you can control, to a certain extent, how much you grow by in good times. You can also control your underwriting. Now, I never met a community bank who didn't tell me they're conservative underwriters, okay? We're all conservative underwriters. However, banks tend to do the opposite when it comes to underwriting in good times versus bad times because you still tweak your underwriting standards. What most banks do is they loosen underwriting standards in good times because they're trying to win business. And they tighten in bad times because they're scared. Banks really should be doing is the complete opposite. They should be tightening as the good times play out and loosening in rough times. Let's go back to that real estate example I gave you. Say you made a real estate loan in 2010 at a 70% loan to value. Let's just say you made another loan, same type of loan, same market, same everything, but that loan was made in 2006 at a 60% loan to value, a lower loan to value than your 2010 loan. Which loan would you rather have? That 2010 loan, right? That's my point. Now, some of you are probably thinking, whatever, Adam, hindsight's 2020, right? How do you know when you're at the peak or at the trough in any given environment? This all makes sense in hindsight. What about in real time? Well, here's the thing. You're right. You don't know when you're at the peak or the trough until the history books tell you. But what you can do, and what the smartest banks are doing right now, is they're monitoring the trends, and they're course correcting as necessary. I'm going to show you an example. So this was one of our bank clients. This was an analysis. They were a relatively new client that started working with us in 2023, but it's not about us. My point is, this analysis was done in early 2024 as of December 31st, 2023. And the first step was what this management team did. They broke down their portfolio by vintage, by year of origination, and it looks something like this. So for example, right now, if you look at this graph, as of December 31st, 31st, 2023, this bank had $42.6 million of loans still on their books, originated in 2017. Okay? And you can see the breakdown by year of origination, their portfolio. Most banks don't look at their portfolio this way, but I'm just getting started. The next thing this bank did is said, hey, how are we going to monitor, let's call it vintage risk? And what they concluded was, we can't look backwards. We got to take a forward-looking approach to measuring risk. And what they said was, we really only have charge-offs in bad times. I think 80 or 90% of their charge-offs were in, 2 or 3 recessions that happened in the previous past. They said, all right, we don't know if a recession's coming or not, but why don't we simulate a scenario that looks like 2008 all over again? Not because the possibility is high of that scenario occurring, but because it will give us a way to measure risk. And what they did is they ran it at the loan level, and then they looked at the results by vintage cohort. And you see this line show up on the graph. Let me explain to you what's happening. Remember that $42.6 million of loans originated in 2017, still on the books? When they did that simulation, they calculated that 1.7% of that $42.6 million would be at risk in this forward-looking scenario. Okay, so it's a measurement of risk. That's all you need to know. But look at the trend, right? The measurement of risk increased particularly in a sharp way in 21 and 22, right? The dollars this bank had risk was much higher in those 2 vintage cohorts. And what they started to do is, once they started to pick up on this trend, because they weren't doing this analysis prior to that, in 2023, they said, we got to course correct. We got to tighten our underwriting standards a little bit. And so in 23, you could see that loss rate came down a little bit. But this isn't about risk by itself. There is nothing wrong with taking risk. And frankly, taking more risk in certain years is a natural part of lending and shouldn't be avoided, and you shouldn't be scared of it. The real issue is, are you getting paid for that risk? So let's look at the reward side of the equation, because it's the risk-reward trade-off that matters. So what this bank did is they said, okay, we have a measurement of risk here. We could see our 21 and 22 loans are riskier. Let's look at the reward side and look at the risk-reward trade-off. And they looked at the weighted average yields of each vintage cohort as of 12/31/23, and you see a line like this. Taking more risk in 21 and 22, that's not the problem. The problem is that not only did they not get paid to take that risk, they were getting paid less than they were on loans they did before that. The risk-reward trade-off is terrible on those 21 and 22 loans, but they course-corrected in 23. And what this bank's doing is every quarter, they're rolling this forward, and the numbers change a little bit. But the real question is, what are the trends? Is the risk improving? The reward improving? And in some cases, some banks you can make a case in 23, maybe they overreacted a little bit. Maybe they could loosen just a little bit and win a little bit more business, because the trade-off, tightening underwriting standards, is harder to find loan volume. This is just an example of the type of tools that banks are using to manage what I call vintage risk. And I'm not up here saying don't make loans in good times and only make loans in bad times. It's shades of gray. I'm saying be careful in good times, but be opportunistic in bad times. Principle number 2, every penny of capital counts. Now, what I'm really trying to say here is this. I think, and from my experience, most community banks are way too casual about their capital. And, I talked to the average CEO of a community bank who's got lots of experience and a lot of success, right? So it's hard to argue with him or her. But they'll often say to me when I ask them, like, hey, how do you think about how much capital you need to hold? They'll say, well, Adam, what's really worked for our bank is we like to be conservative with our capital. We like to hold 10, 11, maybe 12% capital. We feel more comfortable that way. Our board sleeps better at night that way. That's what works for us. That might be working for you now, but are you sure that's going to work for you in the future? There are a few banks, probably more in this room as a proportion of the industry as a whole, it's a very small slice, who have the best of both worlds, who can be conservative with the capital they hold and still generate outsized return on equity for shareholders. Those are unicorns. But there's a cost to being conservative about capital adequacy. And I think a lot of banks underestimate this. It is much tougher today than it has ever been for a community bank to justify its independence. And a big part of justifying your independence is generating a sufficient return on investment for your shareholders. And you may be able to do that now. But if I bring this back to the beginning of this conversation, where you may need to step outside your comfort zone, and you're trying to get your bank to the next level, using asset sizes as an example, you may not have that luxury. So there's nothing wrong with being conservative. I am not up here saying be conservative. But what I am up here to say is there's a cost to being too conservative about your capital. And banks often forget every penny of capital counts, because every extra dollar of capital you're holding on to, you don't need to, is earning 0% return for your shareholders. Right? Keep that in mind. And when things are going well, it's kind of like raising capital. When's the best time to raise capital? When you don't need it, right? It's kind of the same thing here. Most of you in this room are strong enough where you're holding lots of capital and you're still generating great returns for your shareholders. This isn't a problem for you yet. So it's actually the best time to do this type of exercise. And that exercise is this, and it really comes down to this. You have two choices. Choice number one, you can take the initiative and calculate what your capital requirement should be based off your unique balance sheet, your unique loan portfolio, your unique business model and earnings and community and footprint. Or the second choice is a lot easier, but a lot more dangerous. You can take what I call the regulatory safe harbor. What is that? What is the regulatory safe harbor? Well, if you asked me what that was 10 years ago, a few years after the '08 crisis, I would have said, you know what the regulatory safe harbor is? 8% is the new 5. That's what I would have told you in 2014. You want to know what it is today? Well, I don't know, because 5 years ago, they came out with the community bank leverage ratio. That was at 9%. And some banks adopted it. And a lot of those banks, some of you in this room maybe aren't feeling this yet, but I know banks that are, who adopted the community bank leverage ratio at 9. And the regulators are going in there and telling them, yeah, 9's the written minimum. Kind of want you to hold above that written minimum. We want you at 9.5. And it's not in writing. This is wink, wink, okay? And banks that did not adopt the community bank leverage ratio are almost getting slowly and gradually pushed towards 9, right? And I know banks that regulators are pushing them towards 10. My point is, this so-called safe harbor isn't so safe. And it feels like the regulators are slowly but surely always moving the goalposts further and further back. But be careful with that. Now, I want to show you another example of a situation involving a bank who was at a crossroads with this choice. This bank was about $1.2 billion in assets. And look, it had plenty of capital. Leverage ratio was 10-4. But they were hearing through the grapevine from their peers that their local examiners were going into banks and basically setting an expectation about capital and kind of telling the banks, like, hey, we kind of want you at 9%, right? They're setting this expectation. And this bank had an exam coming up in, 10 months. So what management decided was, hey, let's open door number one. Let's at least do the math and see what our ideal capital limit would be. And you know what? If it's greater than 9%, we'll take the 9% safe harbor. Let's see what it is. Now, if they took the safe harbor of 9%, here's what their capital would look like. If you divided it into offense versus defense. The first 9% of their capital, that's defensive capital, $105 million. That's capital that's basically encumbered. They can't touch it. It's required to support their existing balance sheet if they take the safe harbor. The good news, I guess, is they have $16.3 million of dry powder. That's nice, but again, every penny of capital counts. The question is that the right division of their capital into defense versus offense? So what they did is they said, let's do the math. And I'm not going to bore you with the methodology, okay? But they use the same methodology that large banks use. And again, I won't bore you with that. If anyone's interested in that, I'm happy to discuss it with you afterwards. But what they said is, okay, let's look at our capital this way. A three-story building instead of a two-story building. And the first thing they said is, all right, what we really need to set aside immediately is 5%, because that's a minimum for a well-capitalized bank. That we know we have to set aside. The real question is, how much additional capital do we need to set aside? And when a regulator walks into a bank and says, wink, wink, I want you at 9%, you know what they are subconsciously telling you? They are telling you, hey, just in case something really bad happens, we want you to hold an additional buffer of plus 4%, above the 5% minimum, so you have that additional buffer to burn through just in case. That's what they're telling you. And you know where they got that number from? They won't be able to tell you, but if you ask their boss's boss's boss, they'll tell you. I'll tell you where it came from. It came from an analysis the regulators did of failed and troubled banks following the 2008 crisis. So think about this. These rules of thumb, I don't care what they are, 8%, 9%, 10%. When regulators use rules of thumb in terms of telling you how much capital you should hold, those rules of thumb are based off the lowest common denominator bank. Yet, we have some of the strongest banks in the country in this room. Doesn't make a lot of sense. So what this bank did is said, okay, we don't know if plus 4% is too much or too little. Why don't we calculate how much capital we would actually burn through? And let's simulate again another doomsday scenario. And they did the math, and they actually came out to 3.2%, 3.2. Add those two numbers together, they concluded their capital requirement for their bank, based on their unique profile, should be 8.2 instead of 9. May not feel like a big difference, but it is a huge difference, because at 8.2, they have 25.7 million of dry powder. And when you compare the two choices this bank had, take the safe harbor, have $16 million of dry powder, or take the initiative and calculate your own requirement. When the regulators come in, you have it ready, it's not even a question, and you codify it into your capital plan, this bank ended up with 25.7 million dry powder. That's a $9.4 million difference. Pick your multiple. You want a 10x it, 12x it? How many more loans can you create with that? That's like raising capital at a fraction of a cost that's not dilutive at all to your shareholder. I believe, personally, management teams have a fiduciary duty to try to optimize how much capital is set aside for defense versus offense. And the beauty of this exercise for this bank was by setting an internal limit at 8.2 instead of 9, they didn't put their bank at any additional risk. None. And look, trying to find loans to fill, to put that extra money to work, that's not easy. That's going to take time. And I'm not saying they should put every penny of capital to work, but every dollar of loans you put on your balance sheet to grow your balance sheet requires capital to support it. And if you free up this type of capital, it can make a huge difference on ROE. If they accepted the safe harbor and they live with their current ROE of 8.4, that's okay, but it's not great, maybe not good enough. If they free up 9.4%, you just do the math, probably make $100 million of more loans, figure out what NIM that brings, right? Figure out what your variable costs are, tax affect it, can make a huge difference on ROE. Huge. So that's principle number 2. Principle number 3, and my last one, which is know your limits. What do I mean by that? Well, we're going to talk about the C word now, because some of you may discover that you may need to develop a concentration in something, certain type of lending. Concentrations have been most commonly discussed when it comes to commercial real estate. That's obviously what's in the headlines now. But it's not just commercial real estate. You could have a concentration in anything. I got clients that have concentrations in ag. I got a client who's got a concentration in something very specific. Skilled nursing facilities as bridge loans for HUD financing. That's how specific it can get, okay? So you can develop a concentration in anything. And I have a big problem with the groupthink right now in the industry. Because groupthink says concentrations are bad. That is crap, okay? For some banks, it's bad. But for most banks, concentrations are healthy. You know what concentrations mean to me, if done properly? It means expertise. And you know what expertise means to me? You know how to manage the risk better. You know what concentration also means to me? Specialization. And you know what specialization requires? Infrastructure investment. And you know what infrastructure investment unlocks? Economies of scale and competitive advantages. We have to get away from this idea concentrations are bad. Because you know what can be bad? Diversifying. I know a lot of banks around 2006, when the regulators began their first wave of CRE, the concerns about CRE, where they stopped a lot of banks from making CRE loans. And those banks tried to pivot into CNI, and they lost their shirts. They didn't have the expertise. They didn't understand the industries of the companies they were lending to. They didn't have the cash management to even get the deposits. They couldn't even collect borrowing-based certificates on a monthly basis. They lost their shirts. Do you know the average loss rate for a community bank in CNI lending following the '08 crisis was double CRE if you ignore construction? Double, right? Now, I saw a great quote from Warren Buffett the other day. I wrote it down. I have it in my pocket. I'm going to read it to you. Warren Buffett said, "Diversification is protection against ignorance. It makes little sense if you know what you're doing." Now, shades of gray, people. I'm not saying all concentrations are good and all diversification is bad. In fact, in most cases, it's the diversification is good. However, not every bank in this room is going to have that luxury of having a beautifully diversified portfolio. And when you find that next growth curve for your bank, you might find it's one or two types of lending that are just crushing it. And you might find, you know what, we just got to stick to these one or two things we do really, really well and just go into more markets, maybe even go nationally and do it. You're way better off doing that than trying to diversify into something you have little to no understanding of. That's all I'm saying. But, of course, concentrations do have extra risk. The regulators and their perspective is, hey, when we analyzed banks that failed in '08, even in the early '90s, our conclusion was the banks that were more concentrated were more likely to fail. And you can't argue with that. So there is some truth to that, right? Concentrations do need to be effectively managed. That encompasses many things you need to do. But I want to just talk about one of them, which is setting your limits. What is your risk appetite? How much concentration relative to your capital are you willing to accept? And once again, most banks don't really know how to answer that question. If I ask a bank, hey, you have a concentration in commercial real estate, what's your policy? 500%, Adam. Oh, cool. Where'd you get that from? Oh, I don't know. We've always had that. It's been there forever. Or I don't know, so-and-so joined our bank back in 2005, and that's what the bank they were at before was using. Those are the kinds of things I hear. Well, I think we can do a lot better I know we can do a lot better than that. Because here's the thing about limits. You set them too loose, you're going to be in the the crosshairs of the regulators, and yeah, you could be putting your bank at risk. You can't argue with that. But equally as criminal, in my opinion, is if you set them too tight. It's hard enough to find loans. We're going to choke ourselves off from making loans because of some arbitrary threshold that nobody knows where it came from. That doesn't make sense either, right? Leaving money on the table doesn't make sense. So you don't want the limits too loose or too tight. So let me walk you through another example of what a bank did. This bank was growing CRE. Its current concentration at the time of this analysis was 310. Now, once, of course, regulators said to them, hey, you better be ready when we come in for our next exam. And one of the things we're going to be looking at is how you manage concentrations. And as part of that, what are your limits? The regulators start to ask banks, whoa, your limit's 500%? Sounds really high. That concerns us. So management, once again, wanted to get out in front of this. They also had another issue, which is their 3-year plan didn't have the concentration going down. It had it going up to 355. And they were also going to use some of their capital for capital actions. So not only were they over the 300%, in an environment where the regulators were basically coming from or gunning for every bank over 300%, their plan was to grow it. And they really wanted to, they felt good about their plan. You could count the losses they had in the last 5 years on one hand. So in their minds, God, this seems unfair if we would have to deviate from this plan when we really feel like we're on top of managing the risk. So they decide, you know what? When the regulators come in, we better be ready. Tell them what our policy limit is and be able to back it up. So they did an analysis. And it kind of looked like this. The chart on the left, think of it as a speedometer. Someone came up with the name credometer. I think it's really corny, so I won't use it again. But think of it as the pace this bank was running at in terms of CRE to capital. They did an analysis and said, again, keep coming back to this. Try to simulate a scenario where, all right, let's simulate doomsday again. And let's see how our capital reacts if we just continue running our bank at the current speed of 310% to capital in terms of CRE. So just think of those capital levels on the right. Think of those as gas tanks, right? How much fuel are we using just by staying where we're at now? That's really the first question. And let's just take the top right ratio as an example, total capital ratio. They were at 13.8 today. In this doomsday analysis, it does fall to 11.1. So they're using some gas just by staying where they're at. Now, you don't want the gas levels to go to empty, right? Ideally, you want those gas levels not to fall below the black little horizontal dashes. So the next thing the bank said is, all right, we still have some gas left in the tank. Let's now evaluate our plan. That goes up to 355 with some dividends. Well, they're using some gas. If I flip back and forth, you could see the gas being used to support the loan growth and the capital actions that they're planning. They actually still have a little gas left. So the question then becomes, how far or how much can I put my foot on the gas and move the speedometer on more to the right before I have a problem? So they did that. It was at 445 they had a real problem. That's when they run out of gas. So what this management team did is they said, okay, we now know our theoretical limit is 445. What we need to do is set a policy limit that's a little bit less than that to be conservative. They set it, I think, at 425. Then they also said, you know what? Besides having a hard limit at 425, we need to have like an early warning trigger, something even less than that, 375. So they went ahead, they codified that in a capital plan, got the board involved and the board to approve it. And when the regulators came in, they had all of this ready to go. They were saying, hey, we're at 310 today. Our plan is to take it to 355. Here's what's in our plan. We have a limit at 425 backed by an analysis and data. It's data-driven. We have an early warning trigger at 375, and this is our process, and we're monitoring this on an ongoing basis. This wasn't just a one-time exercise for them. They're updating this at least a couple times a year. And the regulators were perfectly fine with that. Why? Because they saw a management team that was managing their capital and their risk in a dynamic way versus other banks where they go in and the banks can't even answer any of these questions. And the time to put all this in is when you don't need it, when things are good. It's much easier to do that at that point in time. So if I recap really quick. Number one, timing matters. Understand the role of vintage. Divide your capital into defense versus offense, but try to divide it in a manner that makes sense. You don't want too much in either bucket. Quantify your policy limits, and don't be afraid of having a concentration. Take a data-driven approach to these. Okay? You don't have to do exactly what this bank did and use the exact same methodologies, but take a data-driven approach. And again, implement in good times, because guess what? That's when the die is cast. That's when mistakes are made. It's in the good times. We're about to enter a new cycle. It could be good, it may not be good. It doesn't matter. Now is the time to do it, especially for most of you in this room who probably don't need to do it. But maybe, just maybe, could be a year from now, 3 years from now, you'll be thankful you did.